What's going on, everyone? Travis the Stock Geek here, coming at you with another episode of Stocks to Watch this week, here in the week of October 26, 2020. And it's actually Tuesday today, which means we're 1 week away from national elections here in the U.S. And that's part of the major theme I'm calling the uncertainty theme here in global stock markets this week, because not only do we have elections coming up, but we also have a rise in virus cases in both Europe and North America. So certain countries in Europe like France, Spain, Italy are actually mulling further shutdown restrictions and curfews because the case numbers really are accelerating there. And so we have seen, in fact, countries like France consider full potential 30-day lockdowns again. We'll have to see how that plays out. But even here in the U.S., certain states that are seeing a rise in virus cases, like Illinois, for instance, are bracing for further restrictions. Even cities like Denver have warned that new stay-at-home orders could be possible again. So there's a lot of uncertainty around that. Pfizer had their earnings call early this week, and there wasn't a lot of clarity on their vaccine development. They weren't giving any data out, so we're probably looking at late November or even into December before we hear more about the plan on Pfizer's specific vaccine. So we're still waiting on that news, and that is weighing on markets. We're also looking at a lack of fiscal stimulus here in the U.S. The Senate adjourned without getting a fiscal stimulus deal done, and so it looks like we're going to have to wait till at least after the elections for possible stimulus in the U.S. And, you know, this kind of reminds me of back in 2018. It wasn't fiscal stimulus, but if you remember, there was a big correction back in late 2018. There was a 20% correction in the market, actually, in the fall of 2018 when the Federal Reserve wasn't really listening to markets and wasn't really paying attention to the actual inflation data. They were raising rates despite the fact that there didn't appear to be a whole lot of inflation risk at the time, and markets didn't like that. And so you saw markets sell off really abruptly, like I said, about a 20% correction back then. And the reason this reminds me of that is because the fiscal decision makers really have not been paying attention to what the market is asking for here. And I think the market's going to be pretty upset about that. If fiscal stimulus keeps getting pushed out and support for the consumer gets pushed out, especially in light of the fact that we have rising virus cases and also a lot of other uncertainty elsewhere, and we still have a 9% unemployment rate, I think this could be a pretty bad mix for global markets. So we'll see how this shakes out. Right now, the markets are holding up, relatively well, only down about 1% or 2% so far this week, and still holding above their moving averages, 50-day and 200-day, but that could change, obviously, within a couple of days. So we'll have to keep an eye there, but I definitely think we've got heightened risk this week heading into the elections. So we also have the holiday season coming up, really starting mid to late November and obviously well into December, which is a big time for consumer spending. So this could have a pretty big impact on companies for Q4 and Q1 next year. Now, we're also in the middle of Q3 earnings reporting season, and I want to talk about some highlights that we saw from companies last week. Overall, I would say the earnings reports for Q3 look actually pretty good, so that is one bright spot here in the markets. However, it's also worth noting that stocks have not necessarily reacted well to the earnings reports. Intel, which slightly beat expectations, saw a 15% decline in its stock after the earnings report. SAP, the big global enterprise software company in Germany, they didn't report a great result, and their stock was actually down pretty significantly, about just over 20% after their results. Even stocks that have been reporting pretty good results, some of the high flyer stocks that are really popular as well, like Tesla and Netflix, their stocks have been relatively weak after their earnings report as well. Now, there are some outliers. We did see with Snapchat, for instance, that their stock was up over 40% after their earnings results, and their numbers looked really good, frankly. We can dig into that a little bit more. When we look at some of the more sensitive, economically exposed companies' earnings, like the airlines and the credit card companies, here for Southwest, for example, you can see earnings results still pretty ugly. Their revenues are still down close to 70% year over year. And, I will say Southwest is navigating this pretty well. They have about 3 years worth of cash needs on the balance sheet. And they continue to see some slow improvement in leisure travel. So they are starting to slowly climb back up to pre-crisis levels, but still pretty far off the absolute levels that they need to be at for profitability. When we look at the credit card providers, data providers, American Express here calling out that their non-travel and entertainment spending for Q3 was actually up slightly year over year. Now, of course, their travel and entertainment spending is still a pretty big category for them, and so that led to overall revenue decline still for Q3, but it is interesting to see consumer spending outside of travel and entertainment for American Express is actually doing pretty well again. We also saw with Capital One that their credit card metrics look pretty good. They, in fact, are taking lower loss reserves now here in Q3, which was a reversal of what we saw in Q1 and Q2, where they had to increase their credit loss reserves. And so if you look at their capital ratios, those have started climbing back up again. So overall, they see pretty healthy trends with end consumer performance, but that could change, obviously, with Q4 or potentially any kind of weird stuff that might happen with shutdowns again. So there is a lot of uncertainty heading into Q4, and markets appear to be reflecting that because they're not rallying significantly on most earnings reports. So we do get a lot more earnings reports this week. In fact, nearly 40% of the S&P 500 reports just this week. So you can see here some of the earnings releases that we're getting this week. Major bellwethers, including Microsoft, AMD, we've got Visa, Etsy, Pinterest, Fastly, Shopify, Amazon, Apple, Facebook, Twitter, Spotify, Exxon. So very, very large and important companies reporting this week. And that's just a handful that I mentioned of the many that are reporting this week. So we have already had a couple of reports like AMD, and they had a really, really robust revenue growth number, very, very healthy trend. But again, a stock that's actually not gone up after the earnings results. In conjunction with the earnings report, AMD did announce that they will be acquiring Xilinx, which is a large company that makes customizable semiconductors, and that's a pretty big deal. So there will be some dilution. It is an all-stock deal, though, so AMD not taking on a bunch of debt to do this deal, which is good to see. But it will be something that could take the focus off some of the core AMD products in CPUs and GPUs. And so the concern might be that management is getting itself spread a little thin. But overall, I think this is actually a pretty good deal for AMD. It diversifies their product portfolio and puts them into some end markets that they haven't been as strong in. And so this is a pretty big deal for the semiconductor industry as a whole. Now, we also saw Intel that they reported their earnings, and like I said, their stock was down, but they had some interesting parts to what they announced. They did actually announce that they're shipping some discrete GPUs now for the first time in the fourth quarter of 2020. Those will go into client laptops. But they also announced that they powered on for the first time their DG2 line of discrete GPUs. These are meant to compete against NVIDIA and AMD eventually in the enthusiast and gaming segments, and we'll probably won't see those on shelves until 2021 at the earliest. But this is a pretty big play by Intel, and it really means that the GPU market is going to get more competitive overall. So if you're an AMD or NVIDIA investor, this is definitely something to watch. I know Intel has been getting a lot of negative press from the fact that it's been losing its lead in CPUs to AMD and just really not performing as it normally has in terms of its technology leadership. But nonetheless, they are still really undertaking some interesting initiatives. They also announced that they're selling their NAND memory division to SK Hynix for $9 billion, and they will be accelerating share buybacks. So these are all very interesting things happening around Intel, especially when you look at Intel and consider the fact that, they are actually trading at about 10 times forward earnings, which is a very cheap earnings multiple and well below market averages. So if we look at the estimates here on AMD, you can see next year about a $4.60 earnings per share estimate, and then in 2022 around a $4.90 EPS estimate. And with the stock trading around $45, you can see there just under 10 times forward earnings valuation multiple. That's pretty dang cheap, and really one of the cheaper levels that Intel has traded at in a long time. Now, you do have to be wary here of some share loss in CPU to AMD in the near term, and potentially even some slowing trends in the data center side of the business. But overall, I think, for Intel, if they are successful in areas like GPUs over the next few years, and in areas like 5G or in Mobileye, which is their division that serves autonomous vehicles, that this could end up being a pretty interesting long-term bargain. I'm not buying myself just yet, but this is definitely one that I'm going to have on the watch list, and I'm going to keep making sure that I'm up on what's happening in business. Turning to the macroeconomic calendar for this week, there aren't a ton of meaningful releases, but there are a couple worth pointing out. So durable goods orders here on Tuesday. Those actually already came out this morning, and they look pretty good. The September numbers were a little bit above expectations, so that was good to see. Again, another sign that the consumer appears to be fairly healthy overall outside of the unemployed group. But we're also going to be looking at the personal income and spending data on Friday, which will give us a better idea of savings rates and overall income improvement for consumers. So that will be another interesting one to watch. Now, when I look at the unemployment claims, which is something that we get weekly, I was a little bit concerned that we saw an uptick in early October. Last week, that number came back down again below 800K of initial jobless claims. So that's good to see. We're going to keep a pretty close eye on this, especially without that fiscal stimulus coming in the near term. We want to see if the unemployment rate can actually continue to trend down. That would be a good sign overall. But who knows also what might happen in the service sector if we get incremental shutdowns in certain cities or states. So I expect this could be a number that ticks up if we do get those shutdowns or those further restrictions on the ability for people to move around and shop and do business. So this is a pretty important figure for us to keep an eye on in terms of a leading indicator. Let's talk about some stocks that are in focus for me this week. I always like to take note of relative strength in stocks that are going up when the rest of the market's going down. So let's talk about a couple of those. One is Twitter. Twitter's had a really good performance over the last few months. It's gone from the high 20s to the low 50s, and they actually do report earnings this week. And Twitter has a history of being volatile around its earnings releases. In Q3 2019, we saw Twitter actually sell off about 25% after its earnings results. So we'll have to see what happens with their Q3 this year. Now, Twitter has really good growth in users overall so far this year, but they have not been able to monetize it very well, with advertising revenues actually declining and expenses still growing. So that has really cut into Twitter's operating income. And frankly, I'm not really convinced that that trend is going to change a whole lot. Any of those trends are going to change here in Q3. So this stock may be a little bit ahead of itself, but it is suggesting that investors are getting pretty excited about the longer term potential for Twitter. We did see Snapchat, of course, making a really big upwards move in its stock. So perhaps that is flowing through into other social media stocks like Twitter. But again, this is one that we'll have to really digest the results on Thursday and see how the stock reacts, because it could be a pretty interesting move in either direction. We're also seeing some strength in Stitch Fix, which I've talked about in the past. This is a stock that has been breaking out lately and is bucking the trend in the overall retail stock industry, because the other retail stocks not doing as hot. And in fact, some of them are actually still near their multi-year lows, but Stitch Fix is breaking out to multi-month and multi-year highs again. And so this is an interesting one to keep an eye on as well. I bought this stock when it had sold off dramatically on its Q1 results, and it was as low as 12 or 13 bucks a share. Now we've had about a triple in the stock, so it's important to just keep valuation in mind here. This is another one that might be getting a little bit ahead of itself, but it is interesting to note that relative strength. On Monday, I noticed a couple of stocks in the radio industry were showing some weird relative strength. You can see if we pull up like a 5-day chart, Intercom as well as Cumulus Media all of a sudden out of nowhere showed a really big spike, and it made me think perhaps there's something happening behind the scenes here that hasn't made its way into the official company news. So maybe there's an M&A transaction in the works that was being leaked or something funky, because these stocks have been definitely showing some interesting patterns that look to be defying the overall market movement a little bit. Another stock that got a big pump today with potential M&A news was Mastercraft, one of the 3 largest boat manufacturers in the U.S., and this stock was up about 12% on acquisition rumors. There is an activist investor potentially pushing for a sale of the company, and this stock trades for a single-digit earnings multiple. It does have some debt on the balance sheet, but overall boat and RV sales nationally have been very strong this year, coming out of the COVID crisis, as people look to do other leisure activities that they can do domestically rather than doing international travel. So this is a stock that recovered quite well from its lows and is still probably pretty undervalued on a long-term basis. And now you've got an activist investor involved that could be pushing for a sale. So Mastercraft, definitely an interesting one to keep an eye on, perhaps the whole boating sector as a whole here. But definitely nice to see some green in what is otherwise a market that's struggling to go green. One of the more interesting and volatile sectors this year has been energy. In fact, it's one of the worst performing sectors in all of the North American market. And we had more news in that sector over the past few days, like the dividend cut here in Energy Transfer, which the stock did not react kindly to. It was down about 9%. The company's cutting its dividend in half, but even with the dividend cut in half, it's still yielding about 10% in terms of an annual dividend yield. So some of these stocks clearly getting pretty cheap in this sector, very, very beat up and trading at just a fraction of where they were at a few years ago. We've also seen quite a few M&A announcements. We saw Pioneer is agreeing to purchase Parsley Energy in an all-stock deal. We saw Conoco, of course, bidding for Concho Resources. We saw Devon Energy merging with WPX a few weeks ago. So there's a lot of M&A now looking to potentially consolidate the energy markets, and that means fewer players and hopefully better pricing power for the remaining players. And, it could take a while for this to play out. We haven't exactly seen strength in oil prices or anything lately, but this is a sector that is very hated and very unloved, and there could be some bargains really to be found in this sector. So I have some companies that I think are pretty interesting. I typically try to focus on companies like Devon that have a pretty good cash flow profile, even at current oil prices and natural gas prices, and that have relatively clean balance sheets. But there are some cases to be made for a lot of these energy stocks. And of course, there are also ETFs that hold diversified portfolio of these stocks if you want to have sector exposure, or even ETFs like AMLP, which have a really nice dividend yield and hold a portfolio of MLPs. And it's actually structured as a C Corp, so you don't have to deal with some of the complexities of MLP taxes. And, I think there probably will be some more pain. We could see, for instance, a dividend cut in ExxonMobil in the next couple of quarters. They've tried to avoid that, but the market is clearly saying that ExxonMobil, they'd like to see a dividend cut because investors have talked about being concerned about the cash flow profile with ExxonMobil currently. Debt's been going up. Cash flow has not really been enough to cover the annual dividend yield at today's prices. So it'll be interesting to see what happens with this one. This could end up hitting new lows. And of course, Exxon would be an interesting bargain at some price. It's a very well-diversified company with lots of different parts of the business, including not only oil and gas production, but also refining, as well as transportation and storage assets, and even some alternative energy stuff that they are involved in. So yeah, this is definitely a place where I think we can start hunting for some interesting bargains. It might still be a little bit early overall. Lastly, one subsector of energy that's pretty interesting right now is refining. Refiners are very beaten up across the sector this year. There's some pretty interesting stocks in that sector, but Pbf Energy caught my eye because there was some insider buying in recent weeks. The CFO bought some stock. There's also the major shareholder, Carlos Slim, the billionaire out of Mexico, who has been accumulating stock in this company all year, and he now owns more than 20% of Pbf. Pbf, of course, is still down over 90% in the past year, and refiners have seen their margins cut with lower demand for gas and jet fuel this year. But if you believe they can recover to normalized earnings levels, this is a stock that could be a multi-bagger. I think when you look out on a longer-term time frame, I do question whether the demand for gasoline and jet fuel could ever recover to, say, 2018, 2019 levels, especially if we get a really high increased level of EV penetration, electric vehicle penetration, that is. But, in the near term, if this thing does see somewhat of a normalization, again, this one could potentially have quite a bit of upside from the current price. It's in a very hated and unloved sector, and it is very, very beaten up. But there is risk. There's debt on the balance sheet, and it is a company that does rely on end consumer demand for fuel to really be robust, and we don't know what that looks like without a vaccine yet. So it is one that could continue to struggle in the near term. But in terms of risk reward, maybe an interesting one, and definitely one that I'll be keeping an eye on and potentially doing some more work on. And I'll leave it at that for this week. There are plenty more stocks we could talk about, but we'll leave that for another edition. And it's going to be an interesting next few days and few weeks, and hopefully we'll have a lot more clarity on what the world looks like by this time next week even. Until then, I hope you all stay happy and healthy and prosperous, and I will see you all in the next video. Take care, everyone.